SATCOM 1 is a go. Firing up SATCOM 2. SATCOM 2 is live.
The fusion of rational thought and political analysis. This is what your brain has been waiting for. News, politics, and issues. Enhanced. You have just joined the Wilkow Majority.
The next generation of great talk radio, the undisputed leader of the new school. Andrew Wilkow, Sirius XM Patriot. Phone lines, as always, 1-695 Patriot. The email, just spell my name right. WILKOW at WilkowMajority.com. Individual Patriot first, conservative second, Republican third, and working every single day to make this the most popular program offered by Sirius XM Satellite Radio, because it's based in one thing and one thing only, and that is rational thought. So welcome to the Wilkow Majority. I'm Andrew Wilkow. It's a Friday. We don't slow down. We don't back off. We don't take it easy. We go full steam ahead. 3 hours of perfectly executed political analysis. Now, I would normally say we are about 1 week from tax day, but this year, April 15th falls out on a federal holiday, so it's moved to April 17th, right?
That's right. Sunday is April 15th, so then Monday's the holiday, so Tuesday is a tax date. All
right. Rebecca Walser, who's been on the program before, is joining us in the studio. She's author of the book Wealth Unbroken, Growing Wealth Uninterrupted by Market Crashes, Taxes, and Even Death. Real quick, before we talk about, because I think we should move Election Day to the day before tax day.
Oh, great.
I think that we should vote the day before we pay our taxes.
That is such a great idea. Yes. I love it.
Or, and I have even some crazier ideas in this, that we end withholding and make people, all people, write checks to the government. Because if you sat down, if you actually had to sit down every month or every pay period and write a check out to the federal government, there would be a revolution in taxation in this country.
Absolutely right.
Now, real quick, with the tariffs, and I have been consistent on this program, I do not like tariff wars. I do not like trade wars. I understand this president has seemingly been backed into a corner because of the apathy of the past 3 administrations. But what's funny is when the tax cuts went through for corporate and individuals, the immediate reaction from the majority of the media was to only focus on the supposed rich people that were making out, even though the top 20% pay almost all of the income taxes in the country.
Right.
And they were like, well, it's really going in, the corporations are going ahead with stock buybacks and they're bonusing executives while they're bonusing lots of people. But when they talk about Wall Street versus Main Street, you don't have to be a genius investor to go, the market's down.
Yeah.
That's a good time to buy.
Right.
And I'm not going to tell people to buy or sell now, but I will say this. I saw that GE stock was in the toilet the other day.
Yes.
And I went to my online trading account and said, I'm going to buy a few shares here.
Yeah. The value play stock, because it's obviously trading well below its norm, and that has been the trend for a while with them.
But when this is the one thing I don't like a lot about, and I'll separate Fox Business because they're very libertarian.
Yeah.
But there's a certain sense in a lot of financial media that it's really a professional grade style media that average people, you don't really know. And yet, in the era of online investing, any person with $1 in a dream can open a trading account and buy a decent amount of stock in a solid company with a decent dividend.
Right. Absolutely. Yeah, it's definitely, and with
like a General Electric.
Yeah, and with robo-advising, it's even more, available and accessible to the average Joe.
You don't want to promote robo-advising.
No, I'm not saying that I do. I'm just saying the average guy can get advice with a robo-advisor for really cheap.
But in the end, when you look at companies and look, there's always risk associated with investing. A company that has been a heritage company can, in fact, go out of business, right? We have seen it happen. We have seen major
Kodak.
retailers. We've seen major retailers go. But when you look at companies that are paying 5% dividends like Ford, chances are we are not seeing the end of Ford anytime soon.
Right.
And those stocks are trading at between $10 and $11 a share with a 5% dividend. That, for someone who doesn't know much about investing and doesn't have a lot to invest, can get into the game.
Yes, there's a lot of value stocks for sure. And really, Andrew, it's hard for me right now to say buy in, because although we're seeing these cracks in volatility, this is not yet the bear. And I absolutely know for a fact that the bear is going to come. In fact, I got an alert today from a major crediting industry that said we are looking possibly at 2009 levels of the market again. So whether I believe that or not is not the case. The point is the bear is going to come.
Well,
that's the time to buy in.
Let me just qualify with when I buy in nips.
Yeah. Okay. So you're constantly buying.
No. Like maybe a couple of times a year bite off a little nibble, right?
Okay.
Just a little nibble for myself. And look, over 10 years of doing this, I've built myself a nice little tiny, trading. I'm being serious. It's small.
Okay.
But
I'm looking at him like I don't believe him.
Trust me. Look, whether you have a 401k or you have a professional IRA manager, for someone who's not a professional, who doesn't have the time preparing this program to sit and read charts and graphs, and read prospectuses,
No.
I nibble off of things that are fairly low-level investments, public utilities, if they have a decent dividend, and then I just leave the reinvestment thing. I'm not living off of it. Mm-hmm. But I think that's how a lot of people who are not professionals,
right,
and not business school grads or experts in the field, that's how a lot of people do online investing.
Yeah, and I think that's a good way to do it, because you're basically telling me with what you're saying.
It's conservative.
Exactly. That I am not putting all my eggs in this basket, and all my portfolio isn't like I've done this over time in small chunks. And so what you're telling me is I'm doing it where I wouldn't feel pain point if something went wrong. You know what I mean? And that is why doing it over, it's kind of almost like dollar cost averaging, but you're just kind of doing it when you see a value buy is what I think you're saying to me. And I think that's great. That's wonderful. What the problem is that most of America looks at the market as their wealth builder or their portfolio, all of their eggs are in that basket.
No, but what I don't like is, and you get this a lot from the Democrats, this sort of this negative, pessimistic Wall Street versus Main Street.
Yes.
Rarely will you get
see what you're saying, yeah.
Get Democrats to say, you know what?
Main Street is in Wall Street.
Main Street, you have the same opportunities to make these buys.
Yes.
That even okay, you might not be starting the next BlackRock or the next Berkshire Hathaway.
Right.
But you know what? If you've got some money on this, if you are somebody who is, and this is my wife and I, we are both savers, and we are both what's the saying? Where you put off delayed gratification. We're those people.
Okay. That's great.
If you are somebody that's not used to delayed gratification, but you also want to have a little bit more, make your money work for you, you have to take off that. You have to shrug off delayed gratification, your immediate satisfaction,
right.
And it's hard for millennials, right?
Oh,
That's the big thing with millennial investing.
Sure.
If you're snorting condoms up your nose,
yeah,
it's hard. It's hard to delay gratification,
right? Yeah, it's true. I mean, we become more and more instant gratification. I'm obviously going to talk about that in the book, but for you, if you're buying dividend stocks, you're not necessarily delaying full gratification because you are getting those dividends on an annual basis.
Yeah, but I'm reinvesting them.
Okay, you're just reinvesting them. Okay,
I'm not saying okay. Here's all this money.
You're just letting it ride. You're putting it in, and you're listening.
Pretend it doesn't exist.
That's like compound interest right there. If you're just reinvesting the dividends, that's basically what that is.
Well, because the hardest thing about saving is looking at that statement and going, I don't have this money.
Yeah.
Right? I'm going to pretend I don't have this money. It's not there. I'm not going to go out and buy something. I'm not going to live off of it. Is what I mean.
Yes.
And that's for people with good, strong middle class incomes. That's a hard thing to resist, right? There's always that boat or that classic car, that trip to Disney that you just want to take. And sometimes you have to say to yourself, okay, the real value here is in delaying my gratification.
Yeah. I think if you just put together, Andrew, short-term, mid-term, and long-term goals. Long-term is retirement. Midterm is maybe the boat before I retire, and short-term is get out of debt, maybe possibly for Main Street America, right? And if you have these goals in tranches and you can actually achieve them, and the solution to your don't look at the statement as if this is money is to get e-statements and never open them.
or that too.
Right.
Let's talk about the new tax code, and then I'm going to ask you about some other investing vehicles, and one question will be about gold and stuff like that.
All right, good.
We have an entirely new tax structure. It's taking a lot of people, by surprise. It wasn't just tax cuts. The one problem, I wish we had a flat tax. This is what drives me nuts when you start hearing about thresholds like up the first $30,000. This is what makes people just not want to really wrap their heads around it.
They need a professional, right?
Because the tax code is unnecessarily complex.
Yes, that's true. That's true. Well, it's interesting because we thought that we were going to get a more streamlined, tax reform bill here, and that you wouldn't have to go ask a CPA or a tax attorney for this advice. But it turns out that no, it's not the case. I don't know how realistic that will ever be until we get to a major reset of where we are politically. There is just too many interested parties, shall we say, in the equation that are just not going to allow us to get to that postcard filing.
You know what? It's amazing how we know how to make it simple.
Yeah.
Right? We know that a flat income tax or a VAT tax and the elimination of the income tax would make everybody's life easier.
Yeah.
And when you look at states with 0% income tax, it almost feels like the promised land, especially if you live
Welcome to Florida.
Yes, exactly. I look at just my wife says, "Why do you kick yourself?" When we've been looking for a new home for 3 years now. And I don't know why I do this. I mean, I do know why, because I have family that live in Central Florida. My in-laws have a place. We just look at new constructions in Kissimmee, and I'm like, why? How is this house so? Why? Yeah. She's like, stop doing it. Just stop doing it to yourself.
Yeah.
Living in a low tax or no tax state is the opposite of life in a place like New York and New Jersey.
Right, exactly. It absolutely is. Yeah. I mean, a state like Florida, for example, relies on their property tax base and their sales tax base and not their income tax base.
It's still low.
I know. That's why we have so many New York clients.
You look at houses in Florida where, it's 4-bed, 3.5 bath, pool, driveway, 2-car garage, and people are paying $4,000 or $5,000 in property taxes. You move to New Jersey, and a 1-acre plot will be $25,000 in property taxes.
I know, but the blue states will tell you, but we provide all these services to you, Andrew. Like, don't you know what you're getting? Like, our public schools are so much better.
You can keep your bike trail.
So I don't know that it's actually true. I mean, obviously, anytime the government gets involved, everything becomes more expensive, and there's nothing that's really done in an efficient basis. I mean, it's just the facts. We can just look at that. Every example we look at, we see inefficiencies in government run anything. So
last time you were here, we talked about the difference between tax deferred and we were talking about savings.
401k versus,
yeah. This might sound like a stupid question, but is there any new and needed advice going into this tax season, going into April 17th with the new tax code?
So the new tax code in and of itself, I would say, other than just allowing you to save, to actually earn more at a lower tax rate, everybody, pretty much. There's a few examples.
Take all the write-offs.
But there, with the few exceptions, most everybody is actually going to save. And what that means to me is that we've pretty much had the lowest taxes now under the new code since Reagan. And what that says to me is do not contribute to the match, but beyond the match, it just makes no sense to build up a pre-tax wealth plan like a 401k or an IRA. Why? Because what you're saying is you're making a bet that future taxes will actually even be lower than they are right now under 2018 and since Reagan. And there's just no mathematical possibility of that happening, Wilkow. There's just absolutely no possibility of that happening.
It's and that's the thing. Like when you talk to some people who give financial advice, they think they don't like the 401k, but at the same time they'll say if you're not taking the match, it's like you're giving up. It's if you have a contribution match, it's like giving up free money.
It is.
That even if the market does badly, that's money that you would have had none of.
That's right. That's why our standard advice is contribute to the match. Get the free money. Don't walk away from the free money.
It's not free. You got to work there. you got to
get the free money from it matching your money, but only to the match. And a lot of people we're finding now are able to actually get the match while they're making a Roth contribution, which is incredible. The match will go into traditional 401k, which is pre-tax, but their actual money is going into the Roth and they're still getting the match. So this is a new phenomenon. Tell people check with their HR departments and see if they can do a Roth contribution and still get a match, because that's just even better than traditional with a match. But for sure, after the match, we have to look at other things, Roth being obviously one of them.
Now, let me ask you, Rebecca Walser is joining us in studio. The book is Wealth Unbroken, Growing Wealth Uninterrupted by Market Crashes, Taxes, and Even Death. Do you like bullion? Do you like physical gold?
Yeah.
I only like it because I know it's in my hand.
Yep.
And yes, the price can be affected. It can't go to zero. And it's hidden and nobody knows where it is, like a pirate.
Yeah, and I like that. You know, I'm with you. I'm sort of, you know, what can I do that's legal, but yet not necessarily known or reportable? And
because we're across the street from the diamond district, and there's a reason why people buy diamonds, because the IRS can't trace them.
That's right. You know, Andrew. The thing is, there's so many people right now. You can watch commercials on television every day, and they're like, the market's going to go down, you should buy gold, you should buy bullion, you should buy silver. And while all that's true, you know, I just can't help but remember our history. And you just got to remember that, you know, when you have had a history in the United States of America in 1933 of an executive order saying turn in all your gold, and then we couldn't own gold for 40 years privately. I would
have buried it 2 feet deeper.
You know, that's the thing. There wasn't any kind of major, like, you know, I don't know if it's because the Great Depression when it happened and people are already so scared, and I thought maybe the government's trying to help us here, so we're going to do it voluntarily. But there wasn't any kind of like anti-government, you know, pushback from that event. And I think that nowadays it would be different. But actually, in hindsight, looking at what FDR did, it was actually genius for us. And I'll tell you why. Because that's what gave us the gold reserves that made us the largest gold reserves in the world that we still have to this day. And that's why we made the dollar became the gold standard.
But then once we get off the gold standard, you can inflate the current.
That's exactly what happened.
Ruin the currency. You debauch the currency any way you want.
That's exactly what happened. That's why we have $21 trillion of debt. We kept spending. We kept selling our debt. We kept selling our dollars, and now we have $21 trillion of debt. That's what happened.
You know what's funny is that, like, I'm boring Uncle Andrew for all my nephews and my niece and all my friends' kids. When it's birthday, holiday, whatever it is, graduation, I give everyone a silver eagle every time. I buy them by the tube, and it's birthday, put it in that little sleeve and then send it off. And my wife's like, but kids don't want. I'm like, they'll appreciate it when they are in their 20s, and I've been doing this since the day they're born. They're going to have a handful of silver coins that actually have value.
Yeah, I totally agree. You know, it's almost like saying, hey, I'm giving you this money, and it has a monetary value right now, but really, what's the monetary value in the future? So you're basically built-in compound interest into that gift, which you can't really do any other way.
All right, let me ask you this. We got to wrap things up in just about a minute or so. The book is Wealth Unbroken, Growing Wealth Uninterrupted by Market Crashes, Taxes, Even Death. If people got that pay raise, or they got that job, or they got that bonus, going into this new tax code where we're paying lower taxes, what's the best nugget of advice, other than contacting you and saying, I want to become one of your clients? What's the best thing you can do with this new money?
That's a hard one because I'm torn, right? Like I am so torn because what happens is if people saving, believe it or not, if they aren't spending, our economy is so consumer driven from consumer spending. If they don't spend it, you know, that could actually create a pullback in our economy and start to create the recession that I know is coming. So that's scary. So I don't want to tell people.
I like saving. I'm telling you, my wife and I, we're both savers.
We have to build wealth. We have too much instant gratification in this country. We've got to stop. We've got to come up with a plan. We've got to build wealth. But the truth is, because Lord knows, you know, one thing I got to tell you, Andrew, really fast is we are already at 2 to 1, 2 full-time equivalent workers for every one person on Social Security. And that wasn't supposed to happen for 13 more years. So we have got to build our own wealth because Social Security is not going to be there for us. It is just not. Period. End of story. So we have to save, but at the same time, right now, we are in such a little space of market volatility and we're teetering because we're 9 years. You know, this is the second longest blur in the history of our country. We just passed 9 years last month. This is our anniversary.
When do you think the bear market's coming?
Well, I would have told you that we would be overdue for it already, but because of tax reform, because that has kept at bay this recession. So I would say at the max, maybe 12 months more, but we'll be making history if we go another year.
So then maybe I'm kind of pulling the advice out of you.
Yeah.
Maybe if you've gotten a bonus this year and you've gotten a pay raise this year, you got a job you didn't have before, that you hold on to that money in a savings account and wait to buy a year from now, and you open that trading account and you wait for that bear market and then you get in.
Yeah, and people would say they're going to be screaming at you saying that's timing the market and we shouldn't time the market. The truth is we shouldn't time the market because nobody can except for God. But the truth is it's really hard for me to tell everyone, hey, buy in right now because we are at an inflated market. Our equity market is overheated. That is a fact that you can look at the numbers going back over time. You can see it's overheated. There are some value buys, obviously, but it is a fact we're overall overheated and we are going to have a great correction. And most people that are really calling for a correction are saying that it's going to be a big correction. Like I said, we just got an alert today saying 2009 levels, which is, I mean, that's going down 300% from where we are because that's how big we've gone up. So it's scary. And what I'd say is there are some things they can do do that are safe and still getting some growth between now and then when they are able to
And that is?
Well, short-term treasury bills. I mean, things that are not very well paying, but yet short-term and pretty liquid, and yet they're going to give them something better than zero.
Well, not everything has to be Gordon Gekko.
Yeah.
Not everything has to be Blue Star Loves Teldar paper or whatever it is.
Right.
For a lot of people, I look, we have a big audience here. I don't know what everybody does for a living. I don't know what their retirement vehicles are. I don't know if they have a traditional offer of a 401k, but I also don't think that you have to say to yourself, unless I'm going to, this is not the Duke brothers waiting for the crop reports for frozen concentrated orange juice in the movie Trading Places, that if you're not going to become, you can't expect to win the lottery by making a small investment.
That's right.
But you also have to be looking for places where a stock may be performing low, 3, 5, 10%. And then if you buy in, and it comes back up, you did it right.
The truth is, most conventional advisors, and I actually saw one of the main guys, he was on television, Fox Business the other day, and I wanted to throw my heel at the TV screen because he said...
Spoken like a woman.
He said, we're going to have a bull market for several more years, which is just total crap. I mean, it really is. And the reason he has to say that is because he's a wealth manager, and his whole firm's a wealth management firm, and they're getting the calls now all over the country saying, oh my gosh, what should we do? And they're telling all their people what conventional advice is, which is buy and hold. And I'm not opposed to buy and hold, but the truth is, mathematically speaking, if you see that you are higher than you were in 2009, and you take some of those gains and you put them into safety, and then you buy back in less than what you sold them at, then you will do better than the guy that buys and holds and goes through the decline and has to, basically, climb his way out. Because it took 4 years last time. It took 4 years for the S&P 500 to regain what it had lost in the Great Recession. So I don't like wasting 4 years of my life. I like to have more control than that. So I'm not advocating, getting out and timing the market, but at the same time, I am telling you, if you have already gained from where you were and you lock in those gains, buy low and sell high actually does work. You bought in low, you have high now, you sell, you move to safety for a while, and then if you buy back in at less than what you sold at, then you're better off, right? And you just kind of wait till the market kind of figures out where we are, and then you start climbing again. And that guy does better over his lifetime than the guy that just holds through all of these dips.
All right, I got to leave it there. The book is Wealth Unbroken, Growing Wealth Uninterrupted by Market Crashes, Taxes, and Even Death. Rebecca Walser, thanks for joining us in studio.
Thank you.
All right, Wyandotte 695 Patriot 957-2874. We are right. They are wrong. That's the end of the story. The arguments on